First of a very good morning to you, ladies and gentlemen. First of all, I'd like to thank all of you here for taking your time off your busy schedule to join us here today in this very beautiful place. So, my name's Alvin, and I'm the research analyst for FSMOne Malaysia. And today, our topic will be about the cool kids in town, where everyone wants to be their friend, which I'm referring to here is global technology. Global technology has been one of the best performing markets as of year to date. And then, so a lot of people now have the question whether is it too late for us to start investing now, or given the recent market minor correction, some people might be wondering, are we too late already, or is there more blood to come? So in this session today, we'll dive into some of the key trends and some of the reasons that we think whether or not the technology is expensive. So before we start, let's take a look at this. I would like to make a simple disclaimer here as to, first of all, past performance does not indicate future returns, and also, please always invest at your own risk. So, technology sector, as measured by the Nasdaq index, has reached all-time high. And despite recent market correction, right, it is still one of the best performing sector as of year to date. And then it has rise about around 50% for 2023, and then another 70% as of year to date. So the next question is whether or not technology stocks is expensive, or are we too late to invest already? So, regarding to the equation that all-time high equals expensive, I would like to show one very an example here. So I won't tell you the date of when is it, but just take a look at here. Nasdaq has recovered from the market correction and has reached all-time high. So if we were to think that all-time high equals expensive, we might choose to stand on the sideline, or we might take some profit. But you see, what happened next? We were here, and then afterwards, you can see Nasdaq has just gone plus 2 and never come back to the previous level again. So if we do like this, chances are we might miss out a lot of the opportunities. So next, let us dive into a deeper analysis whether technology stocks are expensive currently. Just look at this return comparison. The red line, Nasdaq, yes, it has reached all-time high, but the rally was relatively narrow, mostly leading by your Magnificent Seven, the big tech names, mega tech names. But if you were to take the Magnificent Seven out of the Nasdaq, right, you can see Nasdaq index, the black line, hasn't even really breached the highs in 2021. Why is that? Because people are still uncertain as to whether they don't know what are the consequences of such high interest rates towards the economy, as well as they don't know whether we have successfully achieved soft landing, or it is just a delay of pain. And then also they don't know whether when will Fed actually really cut its rates. So people flock towards big tech names which are more certain in their earnings growth, and they have high net cash position to withstand market volatility, as well as they are the front runner in the AI rally. And then recently, as we move more towards current situation, you can see the rally got even narrower, mostly leading by one name, which is NVIDIA. Next, so you can see we can't blame people for thinking that, for comparing where we are currently against what we have seen in the dot-com bubble, especially for people who have experienced the dot-com bubble before. I don't have a crystal ball with me to tell me whether technology's bubble will burst in the coming months or coming weeks. But what I can do is, let me take you with me, have a stroll down a memory lane and see what are the signs we saw before the technology bubble burst in the 2000. You can see, before the year 2000 where the technology bubble burst, Nasdaq actually recorded 9 consecutive years of positive performance. And then at the latest 5 years, Nasdaq had recorded on average 60% return. If we were to compare where we are currently, it looks like we are just at the early stage. And if we were to look at the chart on your right-hand side, right, normally volatility tends to be low during a market uptrend as compared during a market downtrend. Why is that? Because people tend to be more irrational. They tend to make more wrong decisions when market is going down. But you can see 2 years prior to the technology bubble burst in the 2000s, right? The volatility tends to be higher than average. Why? People are getting more irrational. Market is entering into a euphoric stage. So you can see any movement tends to be big towards the upside or towards the downside. But if we comparing to where we are now, as of year to date, you can see recent price action has been somehow muted compared to what we have seen during the dot-com bubble, suggesting that people now are still rather clear-minded. And if we were to take a cue from the previous US earnings, you can see that within the technology sector, most of the subsectors actually delivered positive earnings surprises, but most of them actually recorded negative daily returns because after the release of the earnings. So these companies actually, they beat the consensus in terms of the top and bottom lines, but maybe some segments or even their guidance didn't meet investors' high expectations, so investors punish them with a sell-off in their shares. So suggesting that these companies are actually priced to perfection, and investors want them to beat all of the slides they create for them. And then suggesting that investors are also, at this moment, is quite conservative. They are not in a euphoric stage yet. So when you see this chart here, what can you notice? The bracket, right? So this is the PE valuation of the tech leaders from now and then comparing to 24 years ago during the tech dot-com bubble. Now, the technology leaders, we refer to the Magnificent Seven. Everyone knows, right? But in the past, the technology leaders are the 4 horsemen, which includes your Intel, your Cisco, your Microsoft, and your Dell. So you can see the tech leaders during 24 years ago is trading at almost 3 times more higher PE than the current situation. That as our current technology, I can't deny that, yes, our tech leaders are now trading above at a premium against the overall S&P 500 index. But these high valuations are actually supported by strong earnings growth. As you can see on the chart on your right-hand side, earnings growth for the big tech index is expected to be the higher compared to the overall technology index and the S&P 500 index. So if we were to just buy based on PE itself, chances are we might miss out the rally. So it looks like we are not yet at a tech bubble yet, but the next question is, can the technology rally continue? So let's take a look at some of the key growth drivers that we think will continue to push technology stocks moving forward. First of it, artificial intelligence. So technology has been evolving year over year, creating new trends, new opportunities, and propel the world towards a brighter, towards the technology sector towards new highs. And if we were to see here, these are some of the technology trends that happened since 1950s, started for mainframe. Then we have PC, internet, mobile, cloud. All these has continued to push the technology sector higher and higher. And now the up and coming one is AI. So AI has been pretty much the savior for the technology sector. You can see here, this chart represents the Nasdaq Composite Index. So if you can recall back in the year 2022 when markets experienced a downturn because Fed kickstart its rate hike, the burst out of the Russia-Ukraine war, so tech stocks has experienced massive drawdowns and that can't seem to find a bottom. But during the end of 2022, the introduction of the release of ChatGPT has caused a lot attract a lot of attention for investors because they see how revolutionary is this AI technology, and then coupled with all the expectation of rate cuts, this technology index has soon surpassed previous highs. So let me just briefly talk about the AI ecosystem. Artificial intelligence can start way back in 1950s. It is a broader field of computer science that deals with creating machines that perform tasks that needed human intelligence. Then we have machine learning, which is a subset of the entire AI, and then we have deep learning, which is a subset for both AI and machine learning. And now the up and coming one is generative AI. The different thing with generative AI compared to other types of AI is that they create new stuff. They can generate new images, text, videos, or the entire conversation. The potential of AI here is that it will change the process flow of the scientific discovery or research and development, or even creating new products and platforms. But given the current architecture of the AI currently, it is more focused on increasing operation efficiency. You can see on the chart on the left-hand side, it shows the survey from the World Economic Forum. Almost 50% of the companies actually expecting AI to drive job growth. But then on the chart on the right-hand side, you can see this is a report from McKinsey. It shows that companies are actually achieving cost decrease and revenue increase from AI adoption, most prominently in the manufacturing sector. You can see almost more than 50% they save in cost and increase in revenue just by adopting AI itself. And then we are seeing companies putting real monies into AI. The number of S&P 500 companies citing the word AI in their earnings call has saw significant increase in the past few years, showing that AI has been the golden word for companies to attract the eyes of the investors. So companies will continue to invest in all of this AI to continue to attract investors' attention. And then most prominently, you can see big tech firms are actually spending tons of money into AI. You can see the capex for AI has been on a very healthy uptrend since 2014. So what will this cause? So these firms, they are actually very fast in adopting AI. So other firms, smaller firms or even medium-sized firms, they don't want to be left out in this AI race. So they will also picking up AI, try to adopt AI, try to create product related to AI. So to achieve cost reduction as well as revenue increase. And moving forward, AI will come into our day-to-day life. For example, Apple just announced their own AI. They call it the Apple Intelligence. So thinking of it as the Jarvis of your from Iron Man of your iPhone. Yes. So the potential of it is that in the past, how do we describe everything is at ease? We call it, everything is at your fingertips. But with the potential of AI, you don't even need to have your finger. You can just using voice or use telekinetic to order the phone to help you do your stuff. So next, the second driver that will continue to drive the global technology is semiconductors. So we are seeing new ongoing structural trends that will drive the demand for semiconductors. So first of all, I assume that everyone in the hall here you have a mobile phone, right? Not to mention that you are still using the flip-flop kind of phone, but we can agree that our mobile phone today is AI ready, but it's not AI adaptable, right? As Tim Cook from Apple mentioned that the newest Apple Intelligence feature can only be used in iPhone 15 Pro and above. if for me, I'm using an older version of iPhone, I wanted to try out the newest Apple Intelligence feature. What can I do? What can I do is only to change my phone. So we will see a new wave of phone switching to drive the demand for Apple as well as the revenue for Apple. And then all these phones, right, they need to be equipped with the newest 5G technology, or even in the future we have 6G, 7G. So a typical 5G phone has a semiconductor value of 2 times more than a typical 4G mobile phone. And then next, electric vehicles. In the past, we have our fuel power vehicle, which the semiconductor value is only at around 10%. But as we transform into an electrification mode of transportation, the semiconductor value will increase significantly in a car. So by 2030, we expect semiconductor value to consist at least 50% of the car. And then next, as we mentioned just now, more and more companies are adopting cloud services because they need to train their AI, they need to adapt their AI, so they don't have the capacity with themselves, so they can only rely on third-party services to train their AI models and stuff. So all this cloud computing, they also need semiconductors to power them. And then next, data centers, one we can closely associate to as a Malaysian. So the massive computing power needed by the data centers to adopt AI is very huge, and these new data centers is actually they need to have like less power dissipation as well as maintaining high performance level. So they need to equip themselves with the most advanced semiconductor nodes. For example, a data center from OpenAI ChatGPT actually consists around 40,000 of NVIDIA chips. So that's the demand there. And so semiconductors is not a hype, but it's a real trend that we are seeing structural growth drivers that will create demand for them. So this is the semiconductor value chain here. So when we talk about semiconductor, what pops up in your mind the most? Most of the people can only think NVIDIA, right? Or some of you more AMD. Okay, so actually the semiconductor value chain is a more complex ecosystem that consists of many companies playing different role in it. NVIDIA, they are a chip manufacturing company, chip designing company. You can see fabless design, NVIDIA is in it. And this space is actually dominated by mostly US companies. Then we have also companies that manufacturing the chips based on the design. We call it foundries. And the degree of precision needed by these manufacturing companies is actually the highest among all of the manufacturing worldwide. So this segment is actually dominated by companies that in Asia Pacific region, such as Taiwan. And then we also have companies that do assembly, packaging, and test. That means they test the products that manufactured by the foundries to ensure that they're giving the best quality to their clients. And this segment is dominated by Chinese companies as well as Southeast Asian companies. And then we have also companies that do all in one. They do manufacturing, they do design, they do packaging and tests. These are called the integrated design manufacturing IDM companies. And then we also have equipment companies selling all of the equipments to the entire semiconductor value chain, which we call it the equipment supplier, which we have US companies, Europe companies, and Japan companies in it. So governments in the past has been ramping up efforts to attract all of these investments, all of these companies to their country, such as you have US, we have the Science and Chip Act, Korea, we have the K-Chip Act, and then also India, Europe, as well as Japan, all have similar measures. But as it stands off today, none of the country has the ability to achieve self-sufficiency for all of this semiconductor. So when it comes to investing in semiconductor, right, we always advise to go for a global approach. So this chart over here you can see is the semiconductor actually has a some kind of a seasonality pattern of its own. We call it the semiconductor cycle. So at first, when demand rise, right, we have the production following up. Companies ramping up the production to meet enough of the demand. But at one point of time, they may find themselves at overcapacity, oversupply of semiconductors. So they will cut down their production, they will trim down their production. And then when the production level gets below the customer demand, that is where the buying opportunity emerge. And then this cycle rolls on. And then now we believe that we are at the correction phase at this rate start over here. And then this up cycle, we expect it to last until at least 2025. Why is that? Because we expect, you can see, semiconductor sales to be robust until 2025. So, yes. So overall, technology isn't a story, but it is a real trend, and we are seeing real earnings in it. You can see the chart on the left-hand side shows the earnings forecast for the entire technology sector by entire S&P 500 index by sector. You can see the top performing sectors with earnings growth were technology and technology-related sectors such as communication services, which we have Alphabet, Meta in it. Then we have information technology, of course. And then we have the third one, utilities. These are the companies that supply power towards all of the technology as well as the AI-related demand. So when it comes to investing in technology, we always we will recommend we are tilted towards big tech firms. I cannot deny that big tech firms are trading at higher valuation compared to the rest of the sector. But what I can tell is I've never seen a company in my life that experience a massive drawdown just merely because it is expensive. But rather, almost all of the time, a deterioration in fundamentals is the main culprit. So we like big tech because of its strong earnings supported. You can see earnings growth are expected to be higher compared to the overall S&P 500 as well as the technology index, at least for 2024 and 2025. Next, these companies actually have a high net cash position to withstand through any market volatility. So they draw down less compared to the other companies during a market downturns. And then also, they will be the front runner of the AI rally. You can see these big companies are actually spending a lot of money in developing AI, in adopting AI, and in creating products related to AI. So when it comes to investment ideas, we recommend for technology, general technology, we recommend the TA Global Technology Fund. And for technology Islamic one, we have recommended the RHBI Sustainable Future Technology Fund. And for semiconductor, we're recommending the Nomura Global Semiconductor Fund for investors who want a more niche kind of investment team. So overall, we do not think that investing in technology is a story. It is not in a bubble yet, but it's just a beginning of a revolutionary industrial upgrade. Therefore, we want to reiterate our 4 stars very attractive rating on the digital economy sector. So you can take your phone out to have a picture here of the summary. So that's basically sum up my presentation today. So I would like to end this session here with this very picture over here with a metaphor. Despite it is being at night time, the Silicon Valley is as bright as always. Thank you.